Hey everybody, it's Friday morning about 9 o'clock. We had a massive sell-off yesterday. As you saw, the market has not opened yet today, but it's looking not so good again. Yesterday we had the tariff announcement. Today we have China retaliating on that, so that's kind of where we are. I wanted to pull up a chart. Is it time to panic, right? Let's keep some perspective here. And this chart is consumer confidence in the stock market. This is a survey that's done by our friends at the University of Michigan, and they've been doing this for over 50 years, but they're just measuring, hey, are people confident in what's going on in the economy and the market? And we can see along the bottom there's 9 blue dots at the bottom that mark the lowest of lows in confidence, little troughs, right? Those low points. And we can see the green diamond on the bottom right. That's where we are today. So it's about as low as it's been. I'm willing to bet that if you took that survey today versus March, it'd be even lower. But we can take a look and see, what did the stock market do coming out of those low points? Are people right? Top left-hand corner says, hey, coming out of those 9 sentiment troughs, the average return of the S&P 500 is 24.1%. So pretty darn good. We've already lost a lot of money, so you want to make sure you're in for the rebound. And so many come in with the thought, well, I just want to wait till things settle down, till the market settles down, then I'll feel better, I'll be able to get back in. Well, that's fine. Let's take a look at the blue dots along the top. When people are at their most confident points, what's the average rate of return there? There were 10 peaks, and that was only a 3.9% rate of return. So if you want to earn money in the market, you have to be invested during these uncertain times. Uncertainty is what causes the market to drop. The market hates it. But the best investors have the stomach to be able to lean into that uncertainty, lean into that weakness. We don't know what's going to solve this tariff problem, right? There's a school of thought that says, hey, if we get these big tariffs on the books, it could justify bigger, deeper tax cuts. We see a corporate tax cut. We see bigger personal tax cuts, which would be stimulative. It would counter this. Now, it's still a big disruption. I'm not going to disregard that, but that's something that could happen. We could see President Trump walk back some of these and declare victory for certain reasons. If he's starting to lose the support of Congress, we could see Congress resist this whole thing and shut it down over time. So, not to mention, by the way, we're coming off a really strong earnings season. We're invested in companies. We're not invested in the government. So companies will weather the storm. They will figure it out over time, though it's challenging now. By the way, if you've noticed, multiples have come down. So as stock prices come down, that's the P in PE, right? Earnings are still forecast to be pretty good. Prices have come down. This is the most attractive multiple we've seen, particularly for like big tech. If you've missed out on what the Mag 7 did last year, maybe it's a pretty good entry point. As you remove Tesla from the equation, those other 6 stocks are now in the low 20s in terms of their PE. So it's not the time to bail out and surrender. As tough as it may be, I think investing is, some say it's simple, but it's not easy. So we recognize this is a tough time. We're here for you to talk. If you have any thoughts or questions, we'd love to hear from you. Thanks so much.